Good afternoon, everybody. Welcome to today's live event brought to you by EQ Derivatives and Russell Rhodes, who's the head of research and consulting and also a CFA. How are you, Russ?
I'm doing quite well. I'm glad I didn't take the CFA this year. It was only a 25% pass rate. Didn't expect that, did you?
You're snuck in just in time. Well done.
Yes, I did. Several years.
So what's on the agenda for today's topic?
Today we're going to talk about. You want me to go ahead and move forward a little bit and show your show this real quick?
No, stay on the first slide.
Okay.
We'll come to the housekeeping in a minute.
Okay. So we're going to talk about index option strategies, and I said index option strategies, but for the examples I used ETF options because they match up well with the, with describing owning a portfolio. So I'm using the ETF as the portfolio. But there are ways that you can get some partial protection, which is something a lot of people have been looking for. And goodness knows everybody in the world is trying to figure out how to generate income. So I thought both were good to combine for a webinar going into what is the most treacherous month, September. So thought the timing was appropriate as well.
We're somewhere towards the end of the summer. That's no fun. Okay.
Yeah.
Well, let me do my little dog and pony show, and then we'll get underway.
Okay.
Can I put it on to
Okay.
for me, Russell? I'm going to put up on the screen here, or Russell's going to put up on the screen, the IBKR disclaimers. If you just take a moment to read that. Russ, can you just advance to slide one, please? There you go. Thank you very much.
Boom. There we go.
If the audience can take the time to read those disclosures, we always put those up at the beginning of every webinar so people are aware of the risks associated with some of the products and services that we may be talking about. Please use the chat panel or the question panel to contact Russell throughout today's webinar. He will get to those questions on the fly, or we'll do a Q&A at the end. And if you want to download a PDF of today's event, then expand the presentation or the handouts panel, and you can download and save to your computer from there. With that said, I'm going to go on mute and hand the microphone over to Russell Rhodes. Please go ahead, Russ.
Okay, thanks a lot, Andrew. So happy Monday to everybody. Today I'm going to spend a few minutes talking about various index option strategies that you can use to maybe hedge some against the downside, but also take in some income when you put those positions on. It just seemed to me that when people don't know this, but now you will know this, we typically plan these out as at the beginning of each year, what the topics are going to be. And I specifically picked this one for August, really for the protection part, but also because we've been at EQD where we do outreach. We've gotten a lot of folks trying to figure out how to generate more income for their portfolio, and there are ways to use index options or options on broad-based ETFs to do both. This is my quick disclosure. I'm here for educational purposes only, and I'm not showing any past performance today, but past performance is never indicative of future results. It's hopeful of future results, but not indicative of future results. And not really talking about much day trading today. I'm going to talk about the markets real quick and the way to get exposure to the S&P 500, NASDAQ 100, and Russell 2000, and through various ETF and option markets. Going to start out talking about portfolio protection and then finish up with a way to get some partial protection and take in income. And it's actually the final bullet point is something when I was at SIBO, I was not allowed to talk about. So, but something I kind of believed in. We had to have the same message there with respect to option usage. And I'll expand on that when I get to that final bullet point. I've got the question box wide open. If you've got any questions as we go along, always feel free to put them in the question box. If it's something I'm going to get to, I'll mention that. If it's something that I think flows with where we are right now, I'll address the questions that go along. And then finally, I've made these webinars a little bit shorter than I used to, because I would always get really good questions toward the end, and then we would also kind of have an open Q&A. So if there are questions that you want to ask that aren't related to the topic of the day, hold off until the very end, and when I hit the summary page, put that question, and I'll do my best to get to that as well. Now, the markets, the S&P 500, I think everybody's familiar with the SPY ETF. The index options are, the big index options are under the ticker SPX. The SPX options are basically one option for every 1,000 SPY. And typically an SPY option would be one option for each 100 SPY ETF. The XSP is an index option that continues to gain popularity. It's basically a one-for-one relationship with the SPY. It trades at CBOE and has the cash settlement, European-style benefits of index options, but a smaller size that matches up with the SPY options. The triple Qs, there are options on that. The NDX options are about, I think, like 41 or 42 times the size notional of QQQ options. That number changes a little bit over time. Recently, the NASDAQ folks introduced XND, which is a smaller size index option. So any of the options on the QQQ, the NDX, or the XND, those strategies, you can use the strategies I'm going to talk about using options on any of those three. And the same thing for the Russell 2000 ETF. IWM, the RUT options are much larger, 10 times the size actually, and the mini RUT options, ticker MRUT, those options are fairly new. They actually do have some liquidity. They're the same market makers in RUT are involved in MRUT, so it is possible to get some things done in that market as well. Now, strategy-wise, I'm going to start off just talking about income a little bit, and then get into portfolio protection, and then combining both of them. And the most common income strategy out there is the buy, write, or the covered call. It's typically when I was in my education days, what we would encourage those that are thinking about getting involved in options to trade. It was always the first trade that we would suggest to beginner option traders. It does generate some income, but it will also limit the potential upside with respect to a position. And so just a quick buy right example. I know I'm starting out pretty basic here, but then I'm going to ramp it up, I promise. Just a typical buy right example, and I used pricing from last week with the SPY at 442.5. I just said maybe sell the September 30th. I just arbitrarily picked September 30th expirations for all my examples today. Again, just because September is such a treacherous month. You could sell the SPY 445 call that expires at the end of September and take in 670. Again, this pricing was from last week, and we're all familiar with what a buy right looks like. I also did include the P&L for the stock, and that shows up in the blue line right here. Now, do notice that by selling this call option, by selling this 445 call, you do get a little bit of downside protection. And I highlighted that at 1.5%. So that, although I was instructed never to teach the covered call as a hedge, it does give you a little bit of a hedge here. Deeper in the money call option might give you more of a hedge. And again, we'll cover that when I get to the combination part there. So just showing the buy right because I'm going to refer back to it. Now I'm going to step up a little bit and talk about portfolio protection, how expensive it can be, and how you can go about lowering the expense of that portfolio protection. The industry, we use insurance terms like premium when we talk about options, and the reason is because the industry really does like to equate options to insurance policies. And especially in the index options space or the options on broad-based exchange-traded funds, we, on a very consistent basis, see more puts than calls trade when you're looking at broad-based index options or options on the SPY. And that is because the major use of these types of options is portfolio protection, which is typically the put side. And of course, the most basic hedge, but also typically the most expensive hedge, is a protected put. And I pulled some quotes with the QQQ, switched markets on us a little bit. The QQQ at 367 last week, I took a look at different strikes. Strike price that's down no percent, strike price that's down 5%, the strike price that was down about 10%, and showed the performance cost for each one, how much you're giving up by purchasing that option. And for the 367 put, the offer side was $10. That $10 was about almost 2.75% of the value of the QQQ. The 348, you'd give up 1.25%, but you'd get about 5%. You would not get protection until the Qs had lost 5%. And then if you use the 330 put, we're looking at down about 10%. I know those numbers are, those are the closest strikes to down 5% and down 10%. And you can see that the performance cost, you're giving up less than 1% on the cost of the 330 put, but you're not getting protection until we're down all the way to down to 330, and then that put starts to help you out a little bit and hedge against losses in your portfolio. I just decided to pick the middle one, just arbitrarily, saying we own 100 Qs at 367 and we're buying the 348, paying 460 for it, and combined with the gap between where the strike price is and the cost, and combining the cost of purchasing that put, you're really not getting protection until we're down about 6.43%. And that is, you really, if you own a lot of tech stocks and you are concerned about market behavior between now and the end of September, we really do need to get a pretty dramatic sell-off before you start to benefit from this put. Now, portfolio managers, and I worked with a lot of portfolio managers back when I was on the buy side many years ago. And one of the funny things we would say on the trading desk was portfolio managers would come in and ask us to try to construct some sort of a hedge. They never liked what the cost was around it. And then when I was at SIBO, one of my mentors, Marty Kearney, one of his favorite sayings is, if you're looking at buying an option and it appears that that option is an expensive option, go out and sell an option as well. And that typically leads folks to the collar, which is, it's a good method of going about getting some downside protection. You really do want to be very bearish when you're thinking about putting on something like this, because you are going to give up some of your upside performance by selling a call against either an ETF or your portfolio. The cost is not really a dollar cost, but it's giving up and this comes from an author that I worked with on some CFA materials. He liked to say that you're giving up the sweet spot of returns because you're capping your upside. Now, you've got to be pretty certain that we're not going to get up to that price level. So sticking with the QQQ, and I changed strike prices just a little bit. What I did was I looked at selling a slightly out of the money call and then went down as many strike prices as I possibly could to cover the cost of buying a put option. So this was really kind of arbitrary with respect to choosing 370. Gives us a little bit more of upside, gives us, I think, about 1% of upside. But we also get some protection against a drop below 357 between now and the end of September. And again, you want to, we often talk about selling a call option at a price level where you would be willing to sell the underlying. In this case, if you're just trying to hedge for the short term, you really do want to pick a strike that you don't think is going to get reached between when you put the trade on and expiration. And you're really concentrating on this downside protection here. Now, this is what the payout looks like on this. And we're anything greater than a 2.19% drop in the QQQ between about the middle of last week when I priced this out and the end of September. You start to get some protection there, but you are giving up some upside. In fact, you're giving up 1.37% of upside, which is anything above 370 between now and the end of September. Now, the reason I use the Qs for September is I did some work recently, and I wrote something up about August and September being very difficult months. Turns out on average, over the last 20 years or so, the Qs have actually lost just a little bit of value in September. So a collar would be very appropriate if you think history is going to repeat itself, and we're not going to see a whole lot of upside from the Qs, maybe some potential downside. And so the title of this webinar is Combining That Income and Protection. And where I'm going with this one is actually a deep in the money call. So covered call is supposed to be taught as an income strategy. And when I worked at the Options Institute, we all spoke with the same voice. And one of the things that we were, one of the things that I see, Deb, I see your question. I'll get to that one at the end. How's that? So typically in buy right, it's considered an income strategy. I was only allowed to refer to it as an income strategy. But one of the best portfolio managers that I ever worked with would sell in the money call options with a little bit of time value as an exit strategy for stocks that he was ready to sell. In fact, I can specifically remember him selling a Intel call that had about 50 cents of time value, about a month until expiration, and was 10 points in the money. And my response, I was a relatively new trader, my response was, well, you know that the shares are going to get called away. And it was like, yeah, I hope so. And he said, but if they don't, you know, it's the strike price is a price where I'd be willing to buy Intel back. So I've always, you know, the in the money covered call has always stuck with me as a nice hedge or partial hedge. And now I get to talk about it for the first time ever. So looking at the IWM, switched over to the Russell 2000. The reason I switched over to the Russell 2000 is because among the three broad-based indexes that really do have active option markets, the S&P 500, the NASDAQ 100, and the Russell 2000. The Russell 2000 has pretty much consistently had the highest implied volatility this year. And you do need relatively elevated implied volatility to get to come up with an option that will give you a little bit of time value, but also give you some downside protection. And what I settled on here, again, and it's usually an arbitrary settling, I picked the one in the middle, picking the 210. Now, if you add 210 and 1590, which is the premium that you could have taken in for selling this call, you actually do have, I believe, $3.30 of time value in that option, which is a really nice little extra income. In fact, that's 1.48% income based on the IWM being at 222.60. So what I did look at was either buying or owning the IWM at 222.60 and then sell the IWM September 30th 210 call for 1590. And what we get out of this is something that looks like that. Protection down as much as 7.14%. The upside, 1.48%. You can see where those two lines cross over. So if you don't think the Russell 2000 has more than 1.5% out of it, but you are between now and September 30th, but you are concerned about some downside, even though I was initially taught not to talk about an in-the-money call as being a hedge. A lot of people like buffer protect, where you get partial downside protection. This is partial downside protection, but also giving you some upside. And again, about 1.5% of upside using market pricing from last week. Now, the in-the-money buy right, it does offer some partial downside protection. Another strategy, and this is really what when you hear about buffer protect ETFs, and I heard in passing, I haven't verified this number, but I actually heard in passing there are 80 ETFs outstanding right now that follow in a general way the strategy I'm getting ready to show you. And the goals are pretty much the same as what I just showed you as far as the deep in the money call option goes. In fact, I'm sitting here and I'm scribbling down ETF deep in the money call option to see if anybody is following that strategy. As far as I know, they aren't. I have some friends in the ETF business that maybe they should get on that one very quickly. This case, we're getting partial downside protection in a slightly different way. What we're doing is we are putting on a collar and then selling a put option to increase the income. And we're selling 2 options for each one that gets purchased. Specifically, and the IWM dropped a little bit before I could price out my last trade here. But with the IWM at 221.50, you could sell the 222 call at 675, just a slightly out of the money call, and then buy the 211 put, and then finish up with selling the 220 put. And the net result here is income of, I didn't put the income at the bottom, so I'm trying to do the math real quick. I think it's income of 470. So what that allows is 2.12% still of upside. You see where the lines cross right here. We get protection, and this is what a lot of buffer protects look for. They look for protection between down 5% and down 10%, or maybe down 10% to down 20%. A lot of people like to look at selling the down 20% options, typically because down 20% is where the pundits all come in and say, we've hit a bear market, but it also seems to be a level off the highs that attracts a lot of buying. Just because this is a shorter time frame, I went with the down, a protection of down 5% to down about 10%. And the net result there is protection where you've only lost 4.74% until we hit that 200 level. And then because we're short of put, we start to have the losses kick in as well. But this is, the last 2 strategies that I showed combine some goals that a lot of people are out there looking for right now. How can I take in some income, and how can I get some portfolio protection as we go into a treacherous part of the year? So the summary part, we can use options for income and hedging. You can lower the dollar cost of a hedge. You can take in a credit, which suddenly creates some income. And you do want to make sure that you've got limited upside expected in the market when you go to sell that call option. Typically, we talk about a covered call and selling a call at a level where you would be willing to maybe exit the stock you own. That's not necessarily the case if you're really more concerned about selling a call to gather some downside protection. So Deb, I think you had great questions for me last month too. I said 5 to 10% protection, where the protection after the 5%, 10% loss. What advice would you for protecting the first 5 to 10% protection? The first 5 to 10% protection, I would do something like this. Where was that? I forgot the level. I'm moving around too quickly here. Here we go. All right, we got the Qs at we've got the Qs at 367, and just using these prices here, if we were to purchase the 367 put for $10, we could then sell the 348 put, and I had this 460 is the offer price. I was showing the prices where you'd have to buy the option. So let's just say that the 460, we would actually get 450 for selling it. Well, that means that we've got $5.50 of extra premium to cover. What I would do is I would take a look at, I'd start going up the call chain, and if the 368 call is trading right at 550, well, there you go. I've gotten, I get protection from 367 down to 348, and I've given up just about any upside. So that's how I would go about formulating that, where I would purchase the at the money put and then look at selling options based on my outlook to maybe try to cover that $10 the best that I can. If you're worried about a 10% loss, you might, I mean, that 330, taking in $3.30 for the 330 put, 320 maybe, because again, I'm showing the offer side, you'd be looking at trying to cover $6.80 in premium. You may actually have to sell a 367 or a 368 to cover that, but it would most definitely be something that involved buying that I went to the Qs because I knew I had an at the money option up there. I also had the I think I had some at the money options on, the 220. You could pay $875 for it, and I didn't. Right there. I do have some decent numbers to work with. Sorry, one more example on the if you wanted immediate protection, and I should have done an example like that. I almost did, and I kind of wishing I did now. So I had with the IWM at 222, let's just say, or 221.50 right here. So I could have sold right here. I could have sold the 222 call for 675, and the 222 put earlier was around 875. So you could have bought the 220 for 875, gotten some downside protection beyond a couple of points, sold this one for 675, and then sold an out of the money put. Like right here, the 220 put, we could have sold for 225. That still would have taken in a little bit of income and given you protection from 222 down to 220. This is supposed to be, gosh darn it, this is a mistake. This should be the 200 put, as we can see right there. I knew there was a mistake in there. That should be the 200 put. I thought I caught that, but I guess I didn't. So I apologize on that. But you could have combined. You could have sold the 222 call, bought the 220 put, which gives you a pretty good downside protection. And again, this right here, and I can't tell if you guys can see me pointing or not. This should be 200. I'm going to put that spot over that 2 so you can see it was 200. And Deb says, I was thinking of verticals. You can do verticals in order to get some protection like that. But I think because of put skew, where an out of the money put is going to have, if you got a 10-point out of the money put, it's going to have the same implied volatility as a 10-point out of the money, or higher implied volatility than a 10-point out of the money call. So you end up having to do a little bit extra on the put side to cover the cost of protection. Do I have examples with real futures rather than ETFs? I did not talk about the futures in here. I am working on a piece talking about using mini futures and the micro futures. And in fact, that's what I'm going to be talking about for Interactive Brokers next month. So Faisal, I apologize that I don't have a futures example today, but this sometime like this in the middle of next month, same channel, and I will be using, I'm going to go through the growth of the options on futures and strategies like this. And I'm not just going to include equity index. I'm actually going to use some markets that are not equity markets. So I don't at the moment, but I will. So I think I got, oh, and Deb had a question. Are there announcement income options you like? I personally, the Fed announcement, and eventually they're going to surprise us, but I know from some work that I've done that the Fed announcement, which comes on Wednesdays, the option market has overpriced the reaction for several Fed meetings. I think we may even have to go back to early pandemic or pre-pandemic. And we have Wednesday options on the Russell 2000, the mini Russell 2000, the NASDAQ 100, and the S&P 500. And that's when we get the Fed announcement on Wednesday. So I do like putting on positions for a Fed announcement, but more like an iron condor or something like that, maybe even the morning of the announcement with options that expire that afternoon, because we do seem to get a volatility crush right after that announcement. So I did hear Andrew moving around. If there are any other questions with respect to the overall markets, I am an open book.
Now's the time to put them into the question panel, folks, please. And
now's time.
As always, this has been recorded, so we'll receive in 2.5 hours a link to today's webinar from Russell Rhodes. And you can always find them at ibkrwebinars.com. And we'll get Russell's next event posted to the website just as soon as we have just a little bit more information from Russ. But as he said, he'll be discussing the growth of the micro clan in terms of options available on those. So looks like it, Russell. There are no more questions because you do a fantastic job in addressing topic in depth.
All right, I'll take the compliment. Either I confuse everybody tremendously, or it's just so straightforward. So, but as always, I do encourage people to use that email address. I do my very best to answer questions, follow-up questions. And as Andrew said, this is going to be recorded, so it'll be out there. If you're watching this as a recording and you've got a question, definitely feel free to use my email address. And I knew if I stalled around a little bit, I'd get a couple of more good questions. And Faisal was asking, what's the best way to automate strategies on these, and can they be back tested? The back testing is most definitely a cumbersome process. There are tools out there that you can utilize to maybe backtest a consistent option selling strategy. I have done that, but again, it involves me putting a couple of interns to work and pulling data from a Bloomberg more than anything else. I do think that there are a couple of decent services out there that would allow you to try to backtest something like this and get some performance for it. Victor said, how does a beginner get into this slowly, putting one toe into the water at a time? There are two strategies that I would encourage you to consider, Victor. The first one is the covered call. If you've got a stock that, and I switched right back to my SPY example here. If you have a stock that you own and it's close to a price where you would be willing to sell it, sell a call option against that 100 shares that you own. And what that does is it makes you watch, even if it's just one call option, it's in your account. And it is something that, even if it's a small amount of money, it's real money. So you will pay more attention to it than paper trading. When I do live events and I say, who here tries to paper trade? And everybody raises their hand. I say, who here has tried to paper trade and lost interest? And about 75% of people in the room leave their hands up. When you maybe trade a one lot against some shares that you own, that's a good way to put that first option, put that first option trade on. Now, another way to go about doing that is vertical spreads. And I have lots of recordings on Interactive Brokers. I think if you email me, I'll find it for you. But I know that I have done something on vertical spreads. And personally, I think that's another good way to put your toe in the water with options, because a vertical spread is a defined outcome. You know what your potential gain, what your potential loss is. And again, you're going to pay attention to the option price behavior on the option that you sold and the option that you purchased when you put on the vertical spread. But if you shoot me an email, I'll find the link to that video and send it directly to you, because I know about what the time was when I put that one out there. Oh, you're going to go find it, aren't you? I think Andrew's going to go try and find it. Or is there another one coming up on vertical spread?
Looks like we might need one.
I can always do something like that. Buffer income protection. Wayne was just asking. It appears that the sold call, when the cost is somewhat offset by the put sell, will leave the trade with an uncovered call. Wayne, what I was doing, can I have my screen back for 1 sec, Andrew? Because I do want to show. That's a good question, and that means that I was. You guys see my screen, right? Not mine. I have two screens. So I just want to make sure you guys see. Okay. So right here, you would own the underlying in addition to those three option trades. So you're correct. Without owning the IWM, you've got a naked short call here. And right here, this put is offsetting the IWM. Right, the IWM losses down here. You're actually incurring losses on this short put right here. But this is combined with holding the underlying, and that's what the buffer protect strategies do as well. So it does involve. This is really nothing more than a vertical spread and a covered call, both of which can be implemented with a lower permission level. Good question. Thanks for making me clear that up a little bit. Okay, Faisal was asking a data question with respect to Interactive Brokers. I'm going to leave that one for Andrew real quick. And
you just need to subscribe to options data through client portal.
Deb was asking, is there a way to fraction covered call when you have less than 100 shares? There really isn't. There were some equity options out there a while back that were matched up with only 10 shares. I don't think they traded really nicely for some time, and then just kind of I think they withered on the vine a little bit, especially when Apple had a very high price. So 10 shares of Apple was meaningful. Now that Apple has gone through a split, those options I don't think are out there anymore. Plus, to go back to Wayne's question about the permission levels, if you only owned 50 IWM here and you tried to sell one call option against something less than 100 shares, that would not, that you would basically have a naked call option, because it's not fully covered by what you own. So that would be a trade that is limited to a pretty high permission level. Email you, thanks. A follow-up to covered calls. Would you recommend to create a covered call by buying 100 shares? I'm gonna say, you said stocks, I'm gonna say shares, and do a covered call. How would you go about making a good stock to make good income? You want to, if you're thinking about doing a consistent covered call against a stock, you definitely want to look to stocks that have relatively high implied volatility. You'll take in more income there. You want to get a stock that you feel like you're very comfortable with, but and I'm going to open a can of worms here, but I don't have anything other than my statement to share about it right now. But I do know that if you back test using the LiveVol software from that Cboe offers, if you back test using the LiveVol software, if you back test a consistent covered call, if you eliminate having that covered call on when companies report their earnings, it actually improves the profitability. So finding a consistently high volatility, a stock that has consistently high volatility for the options, but also avoiding events around doing the covered call, because sometimes you get a really big up move in the underlying stock and you have capped yourself by selling call option against that.
And Russell,
but it
might be worth making the distinction between a buy right and a covered call.
Sure, absolutely. Buy right is when you purchase the shares and sell the call option at the exact same time. This example was a buy right. If instead of buy, this said own 100 SPY, and then you sold the option, that is a covered call. The real distinction there is how the trade was implemented. But after that, it's the same thing. The name of the tool, it's LiveVol. It's a Cboe software. And it's just something that I know from when I used to work there. I don't really use it anymore. See what happens when I open it up for questions? Good things happen.
Always a problem.
Oh, I like it. No, I think I like it. It makes me start. I'm actually thinking that at some point in the near future, you and I are going to do a webinar called "Your First Option Trade."
Yeah.
I think we used to do that when I was at Cboe, and on a pretty consistent basis, because we were always a good resource for people that were starting out. But Wayne's got me thinking maybe I need to do something along those lines.
I think you've made the point before, Russell. It's very difficult to just. You've got to get amongst it and actually dip your toe in the water, take a position, and monitor it going forward. You've got to you've got an interest in it, right?
Yeah, I tried to track things in a notebook before, and you just lose interest. Whereas if you've got a bunch of other things that you're very active in, at the very bottom of your account, you've got this where I bought a stock and I've shorted a call option, and it's a very small part of your portfolio. It's still there in front of you. So that's why I suggest going that route.
Looks like that's the end of the questions. So, Russell, thank you very much for joining me again today, and we'll see you sometime in September, and we'll get that event posted on the website as soon as we can.
Okay, great. Thanks a lot. We'll talk to you.
Thank you. Bye, everybody.
All right.